Hello and welcome to your first lecture video on Chapter 13. This is the last chapter for Accounting 101, so you are almost done. Okay, so in this chapter, we're going to be talking about corporations in Chapter 13. So we'll talk about, in this lecture video, we'll give an overview of the corporate form. What is a corporation? We'll talk about some advantages and disadvantages of corporations, how corporations are run, the organization of a corporation, and then also talk about some basics of the corporate organizational chart, and then also rights of stockholders and basics of capital stock. Okay, so this lecture video is kind of an overview of corporations. All right, so let's talk about what a corporation is. Give a definition. So a corporation is an entity that is created by law. It's separate from its owners. So it is a separate legal entity from its owners. And that's really important, okay? As we'll see when we talk about the advantages here of corporations. The owners of a corporation are called stockholders or shareholders. All right. Corporations can be privately held or they can be publicly held. And so when we talk about publicly held corporations, which is pretty much what we'll be focusing on in this chapter, what we're talking about are those C corporations that are traded on the New York Stock Exchange or the American Stock Exchange. Okay. So you can buy and sell stock of these corporations on stock exchanges. And when you purchase stock, let's say you purchase stock in Pepsi, PepsiCo is a company, you become an owner of PepsiCo. Okay, you are one of the owners. So I own 2 shares of PepsiCo. I have 2 votes. Not a lot, but I am part owner of PepsiCo. Okay, now the other thing is, like I was saying up here, PepsiCo is separate from its owners. So it's a separate legal entity from me because I'm the owner. PepsiCo is a separate legal entity. Okay. So let's talk about some advantages here of corporations. So it's a separate legal entity. And so it also acts through its agents. So this is something we'll talk more about here in a second, that although I am an owner of PepsiCo, I can't come to the president of Mary Washington and say, today is Free Pepsi Day for everybody at Mary Washington. I can't do that. Okay. Only one of the officers or managers of PepsiCo can do that because a corporation acts through its agents who are the managers and directors and officers within the corporation. Okay. So for example, the chief financial officer. Another advantage of corporations is that there's limited liability of stockholders. And so this is really important, okay? So stockholders, the owners, are not liable for corporate acts or corporate debt. That's huge. So if PepsiCo goes out and does something really stupid, like one of the owners goes out and does something really stupid, they could cause Pepsi to go out of business, right? Lawsuits could cause them to go out of business. But that doesn't mean that those creditors can come after my personal car. I'm an owner of Pepsi, right? But my liability is restricted to my shares of stock. The most I'll lose if Pepsi goes out of business is the value of my shares of stock. Okay? They can't come after my personal house. They can't come after my car. Okay, so there's limited liability for those corporate acts. If Pepsi goes out and does something stupid, there's a lot of lawsuits, and it bankrupts a company, they still can't come after my personal assets, even though I am an owner of PepsiCo. And it's because PepsiCo is a separate legal entity. Okay. Another advantage of corporations is that it's easy to transfer ownership rights. So this is what I was saying a few minutes ago, that you can buy and sell shares of stock on the exchanges, on the New York Stock Exchange, for example. And so it's easy to, it's easy to sell my shares of stock of Pepsi. I don't want to own Pepsi anymore. I can sell the shares of stock. Or I want to become an owner of Pepsi and I buy the shares of stock. Okay. It's pretty easy to do that. Okay. So transferable ownership rights. Continuous life. So if I die, that doesn't mean PepsiCo the company has to start over, right? PepsiCo doesn't go under just because I die, right? It has a continuous life. It is not tied to the physical lives of its owners, which is different than what we talked about with partnership accounting in chapter 12. Remember, one of the partners dies, that partnership ends, and then a new partnership agreement is formed. That's not the situation here. I'm an owner of Pepsi. I die. PepsiCo continues on. Okay? There's also lack of mutual agency for stockholders. That means that stockholders who are not officers and managers, I am not a manager within Pepsi. I don't have the power to bind the corporation to different contracts. So again, I can't come to the president of Mary Washington and say, today is Free Pepsi Day. I can't do that because I'm not the CFO. I'm not the CEO. I'm not even a director. I'm not even employed by PepsiCo. I don't have the authority to do that. Okay. So continuing on with some advantages of corporations, there's also ease of capital accumulation. So when we talk about that, so buying stock is attractive to investors. Why? What makes this an attractive organizational form, and why do people want to buy stock? Well, you're not liable for the corporation's debts. I can easily transfer my stock. I can buy and sell my shares of stock pretty easily, and it's become a lot easier to do that now, especially with the internet and a whole lot of apps on smartphones now. Robinhood, for example, lets you buy and sell shares of stock pretty easily. Used to be that you'd have to go through a broker. Now you don't have to do that kind of stuff anymore. So the transactions costs for buying and selling shares of stock has gone down significantly. Okay. And then stockholders are not corporate agents. And that's what I was saying earlier, that yes, I own 2 shares of Pepsi, but I can't come to the president of Mary Washington and say, today is Free Pepsi Day. Everybody gets free Pepsi. Can't do that. Okay. Only the officers or managers within Pepsi who have the authority can do that. Okay. Disadvantages of corporations. There's government regulation. So there's more government regulation. You have to meet the requirements for the state's incorporation laws, and then you're also subject to additional regulations. Okay, some proprietorships and partnerships could avoid many of those regulations. Also, the idea of corporate taxation. So you may have heard a couple of years ago that the corporate taxes were cut. Okay, corporate taxes were cut. So corporations have to pay corporate income taxes. They have to pay corporate taxes on their income. But as we'll see in a later chapter, what we have is, if you're a shareholder, right, sometimes you'll receive a dividend from a corporation. And so a dividend can be additional stock, or it can just be dollars. It can just be money. Typically, I don't think I've ever gotten additional shares, a stock dividend, but it can happen. I don't think I ever have. I've gotten dividend checks before. And so these are just checks that I could get on a quarterly basis. And it says, for example, with PepsiCo, you know what? Pepsi had a great year, and for every share of stock you have, we'll give you 10 cents, 10 cents a share. And then we distribute cash to our shareholders, 10 cents a share. So I have 2 shares of stock. I get a check for 20 cents. And most of the time, my checks are pretty small. All right, because I don't own that many shares of stock. Now, here's the thing. I am an owner of Pepsi. So the corporation that I'm part owner of has to pay corporate income tax. But then when I get those dividends, which are distributions of assets, cash, from the corporation for which I'm part owner, I then have to report those dividends on my personal tax return. So you could look at this as a form of double taxation. Okay, so that would be a disadvantage. When we talk about corporate organization and management, we have to incorporate, we have to obtain a charter from our state government. It's signed by our prospective stockholders, the incorporators, and then filed with the proper state official. Okay, and so when that application is complete, the charter is issued and the corporation is formed. Investors can then purchase stock, elect a board of directors who oversee corporate affairs. When we have some of these costs to incorporate, the cost to organize a corporation, to set it up, maybe the fees to obtain that charter, any other legal fees, those are expenses incurred. So they're going to be debited to organization expenses, okay? So they're going to be expensed in that accounting period. We talk about management of the corporation. The ultimate control is with the stockholders. Okay, the ultimate control is with the stockholders. Now, why do I say that? Because the stockholders, they typically get one vote per share of stock. So they can then elect their own board of directors. They can elect their board of directors. Okay, and then the board of directors has that final say in how the corporation is run, and some major initiatives done by the corporation has to be approved by the board of directors. Okay, but if you have a group of stockholders who own 50% or more, then they can elect the board of directors that they want to. And then the board of directors are, they'll do their bidding, so to speak. Okay. The board of directors have that final authority for managing corporate activities, but that doesn't mean they're down in the weeds of day-to-day operations within the corporation. Those day-to-day, those managing corporate daily activities, that's delegated to the executive officers. So for example, the president, and then the CFO, the CIO, and we can see this corporate organization chart here. We have the stockholders who elect the board of directors, and then you have the president, and you have the secretary, you have vice president of finance, vice president of production, vice president of marketing, chief information officer, chief financial officer, so on and so forth. And those are the folks who run the corporate activities on a daily basis, okay? When we look at stockholders of the corporation, we have rights of our stockholders. You can vote at stockholders meetings. You can sell stock. You can purchase additional shares of stock. You can receive dividends. This used to be the case, not so much anymore, about you would receive a stock certificate. That's proof that you have purchased shares. That's fading away now because everybody's just buying and selling shares on their apps. So that's fading away, becoming less common. But we can also have some registrars and transfer agents over here. So if a corporation stock is traded on a major exchange, the corporation has a registrar and then a transfer agent. That registrar is going to keep stockholder records and prepare official lists of stockholders for stockholder meetings and dividend payments. So basically what happens is the corporation says, we don't want to do this. This is not what we do. That's not what Pepsi does. Pepsi makes Pepsi and other soft drinks. And so what they do is they say, this is not part of our core activities. Let's outsource finding all of our stockholders and managing those lists of stockholders and finding everybody we have to send dividend payments to. Let's outsource that to another company. And that's what they've done. They say, we don't want to deal with that because that's not what we do. That's not our core business. So we're going to outsource that to another company. And that's all we're saying here is that they'll outsource that to a registrar and to a transfer agent. Okay. So the transfer agent can assist with purchases and sales by receiving and issuing stock certificates as necessary. All right, so I'm going to pause the lecture video here for a second and show you an example of a document that I received from PepsiCo a while ago. Okay, hold on. Okay, so when we were talking about registrars and other shareholder services, this is an example. So this is BNY Mellon Shareholder Services, and so they're trying to get a hold of me to say, we sent you an electronic annual special meeting notice, okay, to that email, but that now is undeliverable, so they're trying to track me down, basically. And so when we talk about some of these shareholder services that companies say, you know what, we're going to outsource that to BNY Mellon because we don't want to have to track down all of our shareholders. BNY Mellon, you do it. We'll pay you money to do it. This is an example of what you could receive, okay? And so let me show you one more example when I was talking about PepsiCo and getting one vote, right? So remember we talked about the ultimate controls with the shareholders, and so you can see down here is that I'm a shareholder of Pepsi and I can vote. Here's the board of directors, and then here's saying we want to keep KPMG, and then some other shareholder proposals that I get to vote on as a shareholder, okay? Now, I typically don't do this. I'm a bad shareholder, but it's because I only own 2 shares of stock, but I should do this, okay? Thanks so much. Goodbye.